Welcome everyone there today. So today I'm going to be talking to you about the very probably boring and slightly painful topic of tax. What I'm going to try and do is try and make it as kind of easy and understandable as possible for everyone, and just try and explain the whole self-assessment process, take a lot of the fear out of there, and hopefully by the end of today's conversation you'll be a little bit more secure in what you need to do as a self-employed person there, what tax returns you have to file, but most importantly, and what I'm going to talk about at the very end of it there, is how we can reduce your tax bill for you there, so that you know what you're entitled to try and reduce everything down there for you. Just a quick overview of myself here and Taxback.com. So my own name is Marian. As Christina mentioned, I am the consumer tax manager here in Taxback.com. So I'll hold my hand up and I will confess to you that I am a bit of a tax nerd. I'm not a tax accountant, but I have a passion for taxes, and most of what I have is a passion for kind of reducing people's tax bills within the parameters of what is legal there. So if there's any kind of nooks and crannies, tax credits, deductions or expenses that you're entitled to, I like to point them out and flag them to people along the way. Ourselves and Taxback.com were established back in 1996, so we're 25 years in operation this year, and what we do is we specialise in global tax returns, so filing tax returns and refund services for people all over the world. And to date, we've actually filed over 1 million tax returns and tax refund applications for people. So I suppose I'm not the only tax nerd in the building here in Taxback.com. So kind of what we'll cover today is the first thing we're going to cover is self-assessment. So what is self-assessment, kind of what deems you as self-employed or brings you into that bracket, and who must file a tax return. So you should hopefully, one of the kind of points that I bring out here, you hear about yourself and go, right, okay, that's it, I need to file a tax return. The second thing we'll touch on there is the different tax rates that you're going to have to pay. So I suppose when you're a PAYE employee like myself, if you've no additional income and not self-employed, you don't really think about the tax rates that you're paid because your employer does all that for you. They get your income for the month, they take out your taxes, and you get what you're left with at the end of it there. When you're self-employed, it's a little bit different there. You actually have to think about your taxes and your tax rates that you're due there. So I'll go through them a little bit for you. And then we start to kind of move on to the nicer things, tax credits and deductions. Your tax credits that will reduce your tax bill, your deductions that will reduce your taxable income. I'll explain what each of them are and kind of how they apply to yourselves there as well. And then the most important thing for yourself then is your expenses that you're entitled to. So it could be your personal expenses in relation to your medical expenses, stuff like that. And most important then as well is your business related expenses there, because they're going to help again. Ultimately, what we want to do is we want to reduce down your tax bill all along the way there for you there, and that we optimize your position for you. Personally, what I like to do as well is I like to take away a lot of the fear when it comes to taxes, because there is a big fear around taxes, especially when you're self-employed. You have that worry, am I doing it right? Am I including everything there? So I want to try and simplify the process as much as possible for you, try and answer as many questions as I can for you there. If you do have some questions along the way, feel free to pop them into the chat box. What I'll do is I'll review that at the end of the session there. We'll go through it then for you, or even at the end of the session there, we'll wait a few minutes at the end. And if you have some questions, if it's kind of a personal one, what you can do is you can pop me an email and we can kind of talk about it in a more private session there rather than a group session here. Or if it's just a general question about, is there such thing as X, pop it into the question box. I'll answer it there, because if you have that question, it's likely that someone else is going to have it. So becoming self-employed. So what does it mean to be self-employed? Who is self-employed? So here in Ireland, approximately 15% of the workforce is actually self-employed. So that's a huge amount of us. I suppose it's coming more prevalent because there's the gig economy, there's people, everyone kind of has a side hustle along the way, be it you're an influencer, you're a blogger, you may have set up a business last year making handmade face masks and they became so essential there. You may have a balloon business selling balloons for people, or you may actually be a fully self-employed person. So you may be working for yourself, maybe a builder, you may be a landlord as well. So basically self-employed individuals must handle their own tax affairs through the self-assessment system. So like as I mentioned, if you're a PAYE employee, nice and simple, your employer looks after all of that bit there for you. If you're self-employed, the responsibility comes back to you. And you'll hear me mention chargeable person throughout the presentation today. And when you're registered for income tax, you'll be considered a chargeable person for self-assessment purposes if you're due to pay tax on behalf of yourself or another person, so your spouse, for a particular tax period. So kind of who are these people? What's the examples of? So the first of all is the self-employed. That's what we mentioned there. Say you're working for yourself, you don't work for employee, or you have income outside of the PAYE bracket. So who's that? That's people like landlords, if you've rental income, if you've investment income, or if you're a director of a company. So if you're a director of a company, it's a proprietary director, it's called. That brings you into the bracket there as well. So I mentioned you could be a PAYE worker with kind of like a side hustle, you might have something else there. So if you're a PAYE worker, so that's your main source of income, but you also have non-PAYE income there as well, you would also be considered a chargeable person if your total gross non-PAYE income is in excess of 30,000 euros. So what does that mean? It means that you're working PAYE and you have additional income over 30,000 euros. Or your net assessable income is in excess of 5,000 euros. So what's the difference between the two of them? So your gross is your total non-PAYE income, and then your net assessable income is your total non-PAYE income less your expenses. So that would mean that you're a chargeable person, you have to file a Form 11. Also as well, if it's a case that maybe you only have a small side business there and your PAYE income is less than 5,000 euros, but you don't have coded into your tax credit certificate, again, you'd have to file a tax return in relation to it. To be honest, it's only a matter of kind of different returns that have to be filed. If it's over the 30,000 euros, you'll have to file a Form 11, register for income tax. If it's below it there, it could be a Form 12 tax return that you have to file there. I suppose the main thing to bear in mind is that if you have any income outside of the PAYE bracket, you're going to have to file some sort of tax return. You need to know yourself about the kind of technicalities of what tax return it is there. We'll let you know, we'll be able to review everything for you and let you know what needs to be done there. The other people that kind of get scooped into this bracket then, so I mentioned it, the proprietary directors. So who's a proprietary director? If you're a director, a named director of a company, and you have a shareholding within excess of 15%, so you have 20% shareholding, you're a proprietary director, you have to file a tax return, you have to register for income tax. It just brings you in and makes you a chargeable person. If you open a foreign bank account, you have to be a chargeable person and file a tax return. If you've gains arising from exercise, assignment, or release of a right. What's that mean? Shares. So if you're in receipt of shares or if you have dividends, stuff like that, again, sucks you into the bracket, you're a chargeable person, you have to file a tax return. Or if you require material interest in an offshore fund or foreign life policy. Now, I'd say there's people probably falling asleep listening to me at the moment here. The main thing to bear in mind, if you're a resident here in Ireland, if you're an Irish resident, you're taxable here in Ireland on your worldwide income. So worldwide income is your income anywhere in the world. So if you have income outside of PAYE or income outside of Ireland, be it like your interest on your foreign bank account, that has to get reported into the revenue here in Ireland. That's what makes you a chargeable person, scoops you into the bracket there. So I can have that kind of cleared up for you there. If any of those kind of 7 or 8 different points that I mentioned there are relevant to you, you can be saying to yourself now, right, okay, maybe I am self-employed, maybe I do fall into this bracket. If it's the case, you're probably wondering now what's the implications. So the implications of being a chargeable person. So I suppose the first thing you're going to need to do is you need to register yourself for income tax. What that is, you have to file a form TR1. And basically this is a form that you send into the revenue to let them know, I am self-employed, you would need to expect a tax return from me. And when you're registered for income tax, you have to submit a tax return to the revenue on or before the 31st of October the following year. So to kind of make that relevant to ourselves, if you were self-employed last year in 2020 and you registered yourself for income tax, that would have been you in 2020 saying, hi, Mr. Taxman, I'm self-employed. You can expect a tax return from me on or before the 31st of October 2021. So it's always the following year that you have to file the tax return. On that date as well, then you have to pay your balance of tax due. So you have to pay your taxes for the year. So again, if we compare it to being a PAYE worker, you're working all year long, your employer is deducting your taxes as you go. When you're self-assessed, you are responsible for your taxes. There's no tax deducted at source. You're getting paid all year long from your customers there. You need to be really mindful of this and putting money aside all year long to pay your tax bill, because come the 31st of October, you have to pay those taxes. And then the last thing you need to pay on that date, and I suppose it's the hardest one for people to kind of wrap their head around, is your preliminary taxes. So your preliminary taxes are basically you prepaying your taxes for next year. So on the 31st of October this year, 2021, your balance of taxes for 2020 is due to be paid, but on that same date, you have to pay your preliminary taxes for 2021. So you're kind of prepaying for next year. It's kind of the revenue's way of getting your taxes somewhat in real time for the year there. So the first year that you're paying taxes, it's a real pain for you when you're filing a tax return, because say, for example, if your 2020 tax bill is €1,000, you'll end up paying €2,000 on the 31st of October because you'll be paying for 2020 for what you owe, and you're prepaying for 2021. But what we'll do is when we go forward another 12 months and you're filing your tax return for 2021, you've banked that €1,000 already. Say, for example, your bill then comes to €1,500 next year. you minus away €1,000 that you've already paid, and you only have to pay €500 there. So the first year is always the worst for the preliminary taxes there, but once you get into the swing of it, then you're carrying it forward. It does work out beneficial for people. And then the last one here, and it's really important when you're self-assessed, is to keep records of your supporting documents for 6 years. So that's across the board. If you're a PAYE employee filing for a tax return for your medical expenses, you need to hold on to your receipt for 6 years, but it's really important for the self-assessed, because the revenue can randomly select anyone for audit for the following 6 years and ask for receipts. And the last thing you want to be doing is in 2028 looking for receipts from 2022 there for petrol that you put in or for fuel allowances or something like that. So keep records of everything. Take pictures of receipts, put them up in the cloud, keep yourself an Excel sheet there, keep records of everything there, because every expense you have is going to reduce down your tax bill. And then when it comes to audit time, if you have everything, it's a lot less stress for yourself there. And that's kind of the first bit of advice I always give anyone when they become self-assessed. There is keep records of everything. Have a box, have an Excel sheet, have somewhere up in the cloud, and every single receipt you have for every expense you have along the way, keep a record of it, because you're not going to remember October next year what you paid it for this week there. So put everything into it there in the box there, and you're not going to miss out on something there. The tax rates, as I mentioned there. So everyone will be familiar with the tax rates here in Ireland. I suppose the first thing to can answer for people, it's a common question we get, is that there's no tax-free allowance here in Ireland. So you're taxable on every cent that you earn in Ireland, be it PAYE income, be it rental income, be it self-employed income there, you're taxed on every cent that you get there. But what happens then is you have tax credits and deductions that reduce down your tax bill there. So on the first €35,300 that you earn, you will be paying income tax, which is commonly known as the PAYE, at a rate of 20% of that. And then for every cent over that there, you'll be paying your income tax at a rate of 40% of it there. So that's the cutoff point. So you reach the higher tax bracket after €35,300. The next thing you're going to be paying is going to be the really controversial universal social charge, the USC, that has been in place now for 10 years and doesn't look like it's going to be going anywhere again. And again, the USC is scaled based on your level of income. So for the first €12,012, you pay it at 0.5%. The next 8,472, you pay it at 2%. The balancing almost 50,000, 49,560 is at 4.5%, and then the balance is at 8%. There's two exceptions to this. I suppose the first is that there's a USC surcharge of 3% if your non-PAYE income is more than €100,000 in any 1 year. So if you're a really successful blogger and you're charging people 10 and 15,000 to do a few swipe ups there for each swipe up, you're going to hit the €100,000 threshold fairly quickly there, and that surcharge is going to be applied to you. On the flip end of there, if your total annual income is less than €13,000 in the calendar year there, you're exempt from USC. And then the last thing we're going to pay is our PRSI, our pay related social insurance, and that's paid at a rate of 4% on your income there. And the only exception to that, I suppose, again, is if your annual income is less than €5,000, you're exempt from PRSI there. So they're the three taxes that you're going to have to pay. The next thing we'll chat about is just kind of the deadlines again. I know I mentioned it earlier, but just kind of to go into again, not to be hammering the drum here on it, but just to kind of really kind of emphasize the importance of it there. So as I mentioned, the 2020 tax year is the year that's open now for filing, and the deadline is the 31st of October. However, there is an exception to that there. If you're willing to pay and file through the Revenue Online System, so ROS is what it's commonly known as there, you can actually extend out that 31st of October deadline into the middle of November. They'll do that every year. So if that means if you're willing to file your tax return online, and if you're willing to pay your tax liability via what's called RDI, it's a ROS debit instruction. So you pay it by mandate to them there. And if you do that, the deadline is extended out to the 17th of November for you. However, if you're going to be filing a paper tax return, or if you're going to be paying it by check or something like that, the 31st of October deadline is strictly applied there for you. Now, you might remember last year they actually extended it out until the middle of December there with everything that was going on and all the different kind of COVID measures there. They did give people an extension. There are many people out there now that are kind of lobbying for that to happen again this year. It's quite possible it might happen. What I would suspect would happen is they'll get to the 16th to 17th of November and they'll roll it out a little bit further. That's happened for the last couple of years, but don't be banking on that. So in your mind frame, if you were self-assessed last year, you have to have your tax return done by 31st of October. And that's not like a starting point at 31st of October. Many people will have their tax return done and dusted for 2020 already. You can file your tax return for 2020 today. and you can set a payment date as the 17th of November. And the benefit for that for yourself, I suppose, is that we can get your tax return done for you this week there, let you know that your tax liability for 2020 and your preliminary taxes for 2021 comes to €3,000. That gives you another month, 6 weeks there to actually put that money aside and have it all gathered and have your ducks in a row so you know what you're facing, rather than you coming to us on the 1st of November. The first thing we'll be telling you then is that we can't guarantee we'll get your tax return done in time, because there's another 40,000 people that want a tax return done in the space of 20 minutes there from us. And the second thing that we'll be telling you there is that, like, you could get an nasty surprise, your tax return will be done and you'll be getting the bill at the same day. So could be calling you back, say, there's a tax bill there of €5,000 and you need to pay that today. So we'd always tell people to kind of make sure that you're aware of there. And the deadlines, the importance of the deadlines is that you want to avoid surcharges, interest, penalties, and you want to reduce your risk of a tax audit. So you're highly possible to be audited if it's the case that you're consistently filing your tax returns late there. For people, you might just, the tax officer, right, okay, we'll see what's going on here with Joe Blogs, because they're always filing their tax returns late. But also as well, what you're going to kind of face into is surcharges and interest and penalties. And what you do not want to be doing is paying more taxes than you want to do. So if you file on time, at least you reduce your risk of them there. I'll go into the surcharges and interest rates later on there. The second filing deadline you need to be mindful of is CGT, so capital gains tax. So your capital gains tax, you need to file a tax return in relation to that after the disposal of a capital asset or shares. So what's that? If you're a landlord and you sell a property, you'll have to file a tax return, a CGT tax return, in relation to the gains that you made in relation. So you bought property for 200,000, you sold it for 400,000 there, you need to file a return and pay the taxes in relation to that there. And the deadlines for this are slightly different than the filing deadlines there. So if the disposal is between the 1st of January and 30th of November, so if you sell between the 1st of January this year and 30th of November this year, you have to file your CGT return by the 15th of December this year and pay the outstanding tax on it there. If it's a case that you sell during the December period, so 1st of December to 31st of December, you get until the 31st of January. So it's a really short window there for you in relation to that. And then one thing to bear in mind is that you need to include that in your tax return on the following year. So if I sell a property now, this year in 2021, next October, when I'm doing my tax return there, I have to include on tax return and indicate that I did sell a property, I had this much of a gain, I paid you my CGT on the 15th of December last year there. So it's what's called a reporting responsibility. And I suppose the reason I'm including that in there is just to let you know as well. And I suppose this is relevant as well for people that have shares, or if you're dabbling in cryptocurrencies in the last 12 months, they're really kind of popular there for people, or if you're one of these people that were at the right side of the GameStop kind of issue there at the end of last year, where people were buying up the GameStop shares. If you were one of the people at the right side of it, you bought early, sold, bought cheap, sold high on it there, you've gains that have to be reported there, and they have to go in onto your CGT return. So there is going to be tax on them there. So just again to be mindful of that. And then this, I suppose, is the scary slide I was talking to. After this now, I'm going to get on to the nice things, your tax credits, your deductions and all that. But just to be aware of the interest and surcharges, because they can be quite penal. And if it's a thing that you have a large tax bill and you're late paying it, the last thing you want to be doing is paying more money on top of that. So what's the difference? So I suppose interest, you can get charged on your overdue tax. So the interest is charged on the tax bill that you haven't paid. So say, for example, you file your tax return in December the 23rd and you pay your liability then. You could potentially have been charged an interest rate of 0.219% per day or part of day that the tax return has been late. Now, that I know that doesn't look like a huge amount, but it all adds up. And if it's every single day you're getting that interest charge, it's going to add up for you there. In reality, in actuality, the revenue are very slow to actually apply interest to people. That's not me saying that they won't apply it to you. Generally, they keep this and they use that for people that are tax evading, or there's huge bills there that are chasing people down for, but it is at their discretion. They can apply it on Joe Blogs, on myself, if I'm a day or 2 days late in paying my tax return. The second thing is the surcharges, and this they automatically apply. So it does not matter if you're Joe Blogs or if you're a big shot businessman there. If you're late submitting your tax return, you will be subject to surcharges. So that's the difference between it. The interest is on your overdue tax. Surcharges are applied because of late submission. So again, if you're late submitting your tax return by 1 day, by a week, by a month, surcharge is going to apply and the amount is going to be different. So for the first 2 months, so even if you're 1 day late or up to 2 months late, automatically a 5% surcharge is going to go onto your liability. So if you think about it, if your tax bill is €1,000 for the year, straight away 5% of that there, it's going to be €50. That doesn't sound like a whole pile, but if it's maybe €10,000 and it's another €500 that you're paying just simply because you're 1 day late filing your tax return there, it's a hard pill to swallow. And then once you go over the 2 months, it's automatically 10% there. So it's really important to get your tax returns filed. And then it's just another thing to bear in mind for any directors that might be on the call. There's no credit allowed for your PAYE paid when determining the tax liability for applying the surcharge. So what that means as well is that not like if you are filing your tax return as a director and you're filing it 1 day late, automatically 5% of all PAYE that's due for you for the year is going to be applied to use the surcharge there. So it's really imperative, if you are a proprietary director of a company, get that tax return filed, get it filed on time, because again, you're just going to be paying a huge amount of tax simply for the fact that your tax return wasn't filed in time. So that's enough of the, I suppose, the negatives and the bad news there. We've covered off what taxes you have to pay, we've covered off when you have to pay them, and we've covered off kind of the penalties for not paying them on time or not filing on time. Now what we want to do is talk about the interesting stuff for yourselves. So how do we claw away at this and bring it down a little bit? So the next two topics we're going to look at are going to be your tax credits and deductions. So again, it's much for muchness. Tax credits and deductions, what they both do is they bring down your liability. It means you pay less tax there, but they kind of come into play at different times. So your tax credits are available for the year to decrease your individual's tax liability. So what does that mean? So your tax credits actually bring down your tax bill. We work out your income for the year, we take into account your expenses, we apply the 20% and the 40% of it there, we see how much tax is due for the year, and then we minus off the different tax credits. So the more tax credits that you can build up throughout the year, the less of tax bill you're going to have as a result of there. And there's a few tax credits we're automatically going to be entitled to. So the first one, resident individuals. Any of us here that are resident here in Ireland, we're entitled to the personal tax credit of €1,650 per year. Automatically entitled to it. We're resident here in Ireland, we get it. So that's going to be the first minus 1,650 off your tax bill. The second thing that the majority of us are going to be entitled to is the employee tax credit, formerly known as the PAYE tax credit. So basically, if you are an employee, you're entitled to another tax credit of €1,650. If it's the case that you're not an employee, so maybe you're a subcontractor or you're a sole trader or you're self-employed or you're a landlord, and that's all you do, you're not an employee, you're landlord with several properties there, you'll be entitled to what's called the earned tax credit. So it's similar to PAYE taxes on your earned income, and it's €1,500 per year, or 20% of your qualifying earned income. So whichever is the lower of the two of them. And then I suppose the final thing to bear in mind is that you could be a combination. So you could be a PAYE worker with some rental income, or you could have a side hustle there. So you can claim a combination of the employee tax credit and the earned income tax credit, but it's capped off at €1,650. So if we take those three tax credits combined, the kind of max they'll come out as €3,300, and that's generally what people have there. But in addition to that, there's other tax credits that you may be entitled to that are kind of commonly known. I've highlighted some of them here for you. I'm not going to bore you, we're going into too much detail on them there. You'll recognize some of there. So like your medical expenses, you can get a tax credit of 20% of them. Your non-routine dental work, again, that's your braces and stuff like that, you can get 20% of them back there. E-worker relief, that's for any of us that are a PAYE employee that are working from home. Like myself today, I'm a PAYE employee, I'm working from home, I'm zooming in to the meeting today, I'm entitled to claim e-worker relief. If it's the case you're a sole trader, you're not going to be entitled to e-worker relief, but you are going to be able to claim your expenses, your home expenses, office rental expenses, stuff like that, utility bills off against it there, so you will get the benefit over there. And there's things like your medical insurance relief, your single parent tax credit, home care tax credit. All of these are high ticket value items there, and I suppose what I want to do is just kind of like highlight them for you there. These are loads of tax credits, are kind of like personal tax credits, so to these regardless whether you're PAYE or self-employed. So be aware of them there. If any of those seem familiar to you, pop me over an email. I can explain it to you in a little bit more detail. And one bullet point I suppose I forgot to include on this here is and many more. I could sit here from today until Friday afternoon and list off hundreds of different tax credits that people may be entitled to based on their own personal circumstances there, but nobody wants that. I've taken up enough of today on you there. One flat rate or expense that I do want to kind of highlight there for people, if you are PAYE worker, it's a thing called a flat rate expense. And your flat rate expense is a tax credit you're entitled to based solely on your occupation. So this is for PAYE employees. So if you're a shop assistant in retail, you get a tax credit of €121 per year, simply based on the fact you're a shop assistant. You'll see there the different lists. Now there's actually over 180 different occupations that are entitled to what's called a flat rate expense. The reason for them, it was back 30, 40 years ago when there were some really kind of powerful unions out there that were able to negotiate these for their employees there. If you're a really talented musician and you're online there today and you're in the concert orchestra, congratulations, you have a flat rate expense of €2,476 that you can claim there again. So hopefully now something along the line there will have kind of hit on at you there. So they're the kind of personal expenses, but I suppose what we want to talk about now is the tax credits and deductions there that you can claim in relation to your income there to try and reduce the ultimate tax bill there. So what's the thing there? So the tax credits I mentioned, they reduce your tax bill. So you work out how much tax is owed and then you minus off your tax credits to get the final bill there. And deductions are different because your deductions are used to reduce your taxable income. So what does that mean? They come into play at the start. So you get your income for the year, then you take away your deductions, and then you start paying your 20% and 40% tax on your income after, if that makes sense there. And deductions can be really valuable there because they're reducing down your taxable income. You can actually get it at what's called the marginal rate. So it could be relief of up to 40% for you. There's two really kind of common deductions there. There's more of them there, but the two kind of really common ones is personal pension contributions. So if you have a pension that's managed through your employer, when you pay your €500 per month towards that pension contribution is taken from your income before they start taxing you on it there. So you get the full value of that. The €500 goes straight into your pension every month there. However, if it's a case you have a private pension separate to work, so if you have a pension with Irish Life that you yourself personally are transferring over €500 per month, that €500, you've already been taxed on it there. So you're missing out on it there. It's actually cost you maybe €700, €800 to put in that €500 into your pension. So you can claim a relief in relation to that there. So you can get back a relief in relation to it of 40% if you're on the higher tax bracket or 20% if you're on the lower tax bracket. That also applies to us PAYE workers if we want to top up our pension. So say we're paying our €500 per month and then we are really lucky and we win the local GA draw, we win €10,000 and we want to know what we're going to do with it there. What you can do is you can pay that into your pension. So you can put that €10,000 into your pension. You can claim the deduction in relation to it there, and you could potentially get a relief of €4,000 for it. So it means you reduce your tax bill for 2020 in relation to that there. Or if it's things you've already paid your taxes there, you could get a refund of €4,000 in relation to it there. So you're kind of making your money worth it there. So just kind of get your brain thinking along that lines of there. Another really common deduction is legally enforced maintenance payments. What does that mean? It means that if you are paying maintenance to an ex-spouse for their own upkeep. So maintenance payments for children are what's called tax neutral. So if you're paying for maintenance to your ex-spouse for the upkeep of your child, there's no tax relief due back for yourself there. You can't claim a deduction in relation to it. And on the flip side, your ex-spouse has no tax liability as a result of there. However, say for example, your separation or divorce agreement says that you have to make maintenance payments of €1,000 per month, 500 of which is for the maintenance of your children, 500 for which is for the maintenance of your ex-spouse. You can actually claim a deduction again in relation to that 500 a month that you're paying to your ex-spouse. And again, that could be at the marginal rate, so that could be 40% of that you're entitled to a tax back or tax relief in relation to there. It'll impact your tax bill. So deductions are as important as your tax credits when it comes to your tax bill there. So the first, it's much for muchness. You don't really need to know it to kind of simplify it all. Your tax credits reduce your tax bill, your deductions reduce your taxable income. Either way, you're not really concerned. All you should know is that to make sure include all your tax credits and deductions there, because ultimately at the end of the day, it's going to help your position. So we've covered off the tax credits and deductions. The next thing we need to talk about is your actual expenses there. So a really common question we get from everyone is, can my expenses be offset against my tax bill? And the answer is yes. And as I mentioned already, the most important thing I always say to anyone when they become self-assessed, be it a landlord, be it a sole trader, whatever it is there, keep evidence of everything. So keep an income tracker of all income you have, but equally as important is keep evidence of every expense you have along the way. Now, what the revenue is kind of line in relation to your expenses is that they must be wholly and exclusively relating to the business. And you're listening to me now and going, holy God, what did she mean by that? And it kind of, they mean the same thing but different, same but different basically. But the word wholly, what it does is it refers to the fact the full amount should be spent for business purposes. So you're claiming an expense, the expense that you're claiming has to be in relation to your business purposes. However, in practice, it's actually possible to distinguish between business and private element of the expense. So even though it says it should be wholly related to the business, there is exceptions. So I suppose the most common exception would be things like your private car or private versus business use of car. So you may have a car, perhaps you set up a business last year selling balloons for parties, and you use that car to do deliveries there, but you also use it for the school runs and you use it for your personal life at the weekends there. So it could be a case that maybe you're using the car for 60% of the time for business use and 40% of the time for personal use. You can apportion it there. So even though the wording says it has to be wholly, if you can evidence and you can back it up and say that the use of it is 60%, 40% there for personal use, the split there, you can portion there and claim that 60% as a business expense. The exclusively is similar there. It refers to the motivation behind incurring the expense. So if we use car again as an example, if you set up an online business and you're giving motivational talks, Marian's motivational talks there, and I say, right, I'm going to buy myself a company car now there, and I stick a sticker on the window and say Marian's motivational speeches there, put my mobile number on it. The motivation behind getting that cost of buying that car, it wasn't business related. It was me wanting to try and offset the cost of a car for myself. I do not need a company car to log on to line there to do a webinar there. So it's not an expense that can't be deducted there. So you really need to think about all your expenses. It's like, what's the use of it there? So do I need it? And what's the motivation behind getting it there? So if you're getting the car for business purposes and you use it for business purposes, it can be claimed. If you're getting a car because you have a business and you want to offset it there, but there's no use of it there, it can't be claimed. I suppose it should be noted that there's some expenses that are kind of disallowed. So if what's going to be disallowed, business entertainment, you can't claim that as an expense. So that's the provision of accommodation, of food, drink, or any other form of hospitality along the way. And then capital expenses such as your tools and overalls. So they don't actually go in under expenses, they will go in under capital allowances. So I'm going to discuss them a little bit more for you as well. So in general, capital allowances is for kind of like your large ticket capital items there, and you don't claim them as an expense in the current year. What you do is you can claim it at a rate of 12.5% of the cost over an 8-year period. So you still get the full utilization of the cost there. You can offset it along the way, but because the lifetime of the product is deemed to be longer there, so you get it over 8 years. So that could be a large piece of machinery or equipment or something like that that's costing you €5,000. You can't offset it all in the 1 year there, so they spread it out over the 8 years for you. So examples of what kind of expenses you can claim. So I suppose the first one, the reason the majority of you are here is through like iconic offices. So the first thing is renting of an office space. That's business expense. You can offset it there. Then your equipment like your computers, your printers, your fax machines, your utility and heating and lighting bills if you're working from home there. So as I mentioned, you can't claim e-work relief and claim your utility bills in as a business expense. So it's one and the other. So if you're wholly self-employed, you'll be claiming it as an expense here. If you're PAYE worker, you may be claiming it as an expense over there. You still get the value of them there. And then the wear and tear allowances of the 12.5%, and that's on the capital expenditure course, as I mentioned, like the large printer, some plant machinery and stuff like that. High ticket value items are generally going to go in as capital allowance. And then your business vehicle running expenses, so your motor tax insurance, your insurances, your service costs, your NCT, your repairs, any business vehicle running costs. So they're kind of the commonly claimed ones there, but again, any expense, if it kind of falls into those brackets of wholly and exclusively business related there, put it in. And what I'd always say was with expenses, put it all on the Excel sheet to ourselves there, list it all out to us. We'll know what to disregard there for you. So rather than you assuming you can't claim for something, put it all down and we'll know what to take into account for you there. What you can't claim there for as well, just to kind of harp on about it a little again. So things like stamp duty, food, your commuting. So if you're traveling to and from work, to and from the job, that's not a tax deductible expense. You can't claim there. Entertainment for clients and the clothing. I have them there beside that with some exceptions. So again, if it's PPE that you have to have, so you have to have you're a beekeeper and you go on site and you move beehives for people there, you're going to have to wear your mask and your suit there. That's PPE. You can claim that there. I don't get to claim my uniform for wearing to work every day because I don't have a special uniform that I have to wear every day. Now, one thing to bear in mind, I have mentioned working from home a couple of times there, but be mindful, if it's a thing that you are self-employed, you're a sole trader, and you have a home office set up, there may be some CGT impact for yourself down the line when you're selling your home if you have a home office. Now, that is only for the self-employed people. If you're a PAYE worker like myself and you're working from home at the moment there's no CGT impact for yourself. So don't be afraid of that there. But if it is something, just to kind of, again, highlight to ourselves, if it is a thing that you have a home office set up for your business there, because it could be an impact down the line for yourself and that. Other expenses I'm going to just kind of touch on a little bit here. It's just rental expenses. This is just kind of purely for landlords to know as well, because in addition to all those other expenses we mentioned, these are kind of exclusively to landlords and they're going to be kind of more common there. The first thing we always get asked about is mortgage. Your mortgage, if it can be offset. So a kind of common answer I get from a lot of people, the mortgage doesn't cover the cost, the rent doesn't cover the cost of the mortgage, so don't have a tax bill. Unfortunately, that's not the case. It's only your mortgage interest that can be used as a tax deductible expense to your payments that you're making on your mortgage. They're not fully offset there. But in addition to that, you things like your RTB, repairs and maintenance, advertising expenses, all of these things along the way, they can be taken into account, offset against your rental income to reduce down again, ultimately your tax bill for you there. The expenses like that are similar as well for the likes of Airbnb. So if you're an Airbnb host or if you're hosting on booking.com or something like that, again, you have to file a tax return. A lot of these rental expenses will be applicable to yourself. It's a slightly different return because you're deemed as having trading income rather than rental income there. But again, list it all off. We'll include it there and reduce your tax bill for you, taking that into account. What kind of costs when you're got rental that can't be offset is things like your own labour. So if your tenants ring you and say the sitting room's got really grotty, I need you to paint it, you go to Woodies, you get yourself a tin of paint and you spend 2 days painting the room. Those 2 days can't be taken, that your labour for those 2 days unfortunately isn't a rental expense there. All that you could claim for there is the paint and the paint brushes that you're after purchasing. Things like your stamp duty as well and your local property tax, again, they're not tax deductible as well, so just to bear that in mind there as well. And then one last slide that I include in every presentation I do, regardless of whether it's for a PUI tax refund or self-assessment tax refund, is I just like to touch lastly on marriage and taxes. It's a thing we have here in Ireland that we're very reluctant to tell the revenue that we're married or to go filing as joint assessment. The response I get 9 times out of 10 from people initially is, I don't want to be giving all my tax credits to my husband, or I don't want to be giving all my tax credits to my wife. The answer to that, and the really simple kind of thing to put around your brain, is marriage tax credits, rates and bands, they're exactly double what they are for a single person. So you can be married or you can be in a registered civil partnership there. You can be jointly assessed and then you can have your tax credits, rates and bands split 50-50. You'll have your tax credits, they'll have theirs. So it'll be the exact same, you won't lose out on anything by being jointly assessed. But what it does do is it gives you the benefit of flexibility. So it means that if it is the case that one of you is on a higher rate of tax and one's on a lower rate of tax, maybe it is more beneficial for you to give your spouse a portion more of the credits there. And what it also does is it entitles you that if it's a case that one of you loses your job or one of you isn't working, you can claim your spouse's unused tax credits there. You can claim the likes of the home carers tax credit. So there's never a negative to being jointly assessed. And also as well, where it could be really useful for you is the year that you get married. So if it's the case that you get married in a tax year and yourself and your spouse are on different income levels, one's on a higher rate, one's on a lower rate of tax year, that's going to trigger a tax refund there for you. And it's bear in mind as well, all the way along the way, you do have the option, you can elect to be jointly assessed, separately assessed, or a separate treatment. So separate assessment and separate treatment are similar, but if you want to be completely separate from your spouse, you can say, I am married, I want separate treatment, and it means that you are treated as a single person. But what that doesn't afford you then is the benefit of your spouse's unused tax credit or vice versa there. So if there's one thing you take away there from it, if you've got married in the last 4 years, joint assessment is the way to go. You will never lose out on something and all you can do is benefit from it there. And then if you indulge me for a minute or two, I'm just going to let you know why I think you should file a tax return here with us at taxback.com. The first, I suppose, reason is the individual consultation. So what we do is we assign you a specialist who will guide you through the process. So you'll fill in your questionnaire there, you'll let us know the different incomes you have, you'll list off the expenses that you think you have there. And what we will do is we'll actually review it there. And usually there's different expense that will go hand in hand with a different type of income. So we'll actually be able to come back to you and say, great, got all your information there. You mentioned actually there that you have rental income, but you didn't mention any mortgage interest. Do you still have a mortgage on the property or not? And that information then will help us to kind of optimize your position there. I mentioned it at the start, we've over 20 years of experience in doing it. I'm not the only tax nerd here in taxback.com, and I suppose our priority is kind of you, our customer, kind of trying to make the process as easy as possible for you and to get the best result there as well. So we'll work to try and get you the least possible tax liability for the year. And even in some cases, we can actually get people into a refund position, especially if you're in a circumstance where you're working as PAYE and you have maybe a startup business there as well along the way. You could actually end up in a refund position there. And if that's the case, that's all well and good. That's better still, even for ourselves. So there's my contact details up in there. I'm just going to open up the chat box now. I'll have a look and see if there's any questions there from anyone there. If you do have a question, you can either feel free to unmute yourself and shout if you're feeling like you want to ask a question there, or you can pop it into the chat box. We can answer it that way for you as well. Is it better to claim mileage or a percentage of motor expenses? So it's not, it depends. So if it's mileage that you have, if that would be if you're an employee. So if you're traveling, if your employer asks you to go to a different office location, so we say, for example, I'm based in our Kilkenny office, but I'd have to go to our Dublin office on occasion to attend meetings and stuff like that, I can claim mileage from the Kilkenny office, the Dublin office, and vice versa there for you. Percentage of motor expenses, that indicates to me as well that you'd have business income. So like you can't claim mileage off yourself as a business. So if it's a case that you're a sole trader and you have to drive to 17 different locations dropping off the balloons, we use that as an example there, it's your motor expenses that you'll be claiming there. So you'll be claiming your fuel, you'll be claiming your motor insurance, you would be claiming your NCT costs there, you may be actually claiming the cost of the car there as a capital allowance there. So it's not is it better to, it's which is more relevant to you, I suppose, would be the answer there. But generally, I would imagine if you're doing a lot of business mileage, you're claiming it as motor expense is the way to go there, but it's not an option. It's not a which or whether you don't get to pick, it's which is more relevant to you there. That seems to be the only question that's come into the chat box there. So if anyone else has any questions, speak now or forever hold your peace, or I can hand back over to Christina. Another question here, is health insurance allowable, e.g. VHI premiums? Yeah, so you get a tax relief. It is €1,000 per qualifying adult, or it's €500 per qualifying child that you get in relation to your medical insurance there. Now, if it's a case that you purchase your medical insurance directly with VHI, you actually get that tax relief at source. So you get it, it's deducted from your cost there. So you don't even see yourself getting it there. So your premium should have been €1,200 in a month, but they only share, or the year, and you only pay €1,000 on it. So you don't actually see it kind of working through, it's built into it. Where you can actually claim a tax relief is if it's covered by your employer. So say, for example, it's a benefit from your employer that your medical insurance costs covered for yourself, your spouse, and your 2 children there. You get taxed on that as a BIK, so you can actually claim a tax relief there. And it's quite valuable. So €1,000 is that per qualifying adults, that's €2,000 for yourself and your spouse. And then if you have 2 children there, again, it's another 1,000, that's €3,000 of tax relief that you can claim in relation to it there. Just have a look there now and see if there's anything else. 2 years self-employed, earned self-employment and PUP this year. How should PUP be taxed? If it was this year, and you're working as PAYE, so your PUP is a taxable income. So it's subject to PAYE. It's not subject to USC or to PRSI. So it's taken into account as taxable income. That's the really kind of unfortunate thing about it there. So it'll be taken into account as your income. So when we're coming to do your calculation there, if it's only PUP you've had this year, it'll be probably the 20% rate if you PUP and you had your self-employment income. So if your business got up and running again for the year and you started making your income there, it just gets added in onto it there. So maybe your sole trader income for the year is €20,000 and then you had €10,000 to PUP. They'd be combined in there, you'd be paying your income tax, your PAYE on that €30,000, but the USC and the PRSI is only going to be chargeable on your earned income, if that makes sense to you there. Another question, direct message here. if you have a rental property in the UK and I'm a PAYE worker in Ireland, do I have to file a tax return in Ireland or the UK? Good question. And I suppose the not very pleasant answer is you have to file it in both. So because you're a resident here in Ireland, as I mentioned earlier, you are taxable here in Ireland on your worldwide income. So you're taxable here in Ireland on your UK rental income. Because the income is sourced in the UK are going to want their portion of it as well. So you'd have to file a tax return in the UK in relation to your UK rental income, pay your taxes there to the HMRC. But then when it comes to reporting it here in Ireland and paying the taxes, you get a deduction, you get a tax relief, a tax credit in relation to your foreign tax paid. So that'll be taken into account there. So there's double taxation agreements all across the world between hundreds and hundreds of different countries. So you don't get taxed on it twice, but you do have to report it in 2 places. So the UK are going to want to report it to them. They're going to want their tax paid on it. Because you're resident here in Ireland, you do also need to report that rental income here in Ireland. And you need to make sure that you take into account the tax paid in the UK, that you're not paying it twice along the way.